What's going on, everybody? I'm Geddis Shonekan, team lead for the ShoBros at Coldwell Banker Vanguard Realty. If you watched my previous video, we talked a little bit about FHA and the main key points. Today, I want to talk about conventional loans. Let's talk a little bit about down payment requirements. Though I've seen some loans get qualified with the buyer only putting 3% of the purchase price down, you typically see 5% of the purchase price is what you need in order to purchase a home with a conventional loan. Let's say you're purchasing a house that's $300,000. If you had to put 5% down, that's about $15,000. Now, of course, I know that's not a small little bit of change, but it costs a little bit of money to get into your first house. Now, let's talk a little bit about mortgage insurance. Now, the benefit of going conventional is that if you're able to put 20% down, you don't have to pay mortgage insurance, unlike FHA. But if you're purchasing with the conventional loan and let's say you only have 5 or 10% down, you will be required to pay mortgage insurance. Now, what is mortgage insurance? Mortgage insurance is protection for the lender in case the buyer defaults on their loan. And yes, you have to pay it. Now, if you build up 20% of equity in your home, all you do is simply request for the mortgage insurance to be removed. Unlike FHA, that you have to actually refinance the loan. So that makes one benefit for a conventional loan. You just simply call and say, hey, I have 20% of equity in the house, run your appraisal. And if that happens, then say, hey, remove my mortgage insurance. I don't want to pay the $70 or $80 premium anymore monthly. Now, conventional loans tend to have stricter requirements from the credit scores than FHA loans do. But the benefit is if you have cash on hand, let's say 20% or more, you won't have to worry about paying for mortgage insurance at all. So if you're a person that's purchasing your second house and you have equity in your first house that you sold and you move it into the second house, mortgage insurance is not a thing you have to even consider. Of course, if you have 20% worth. Something else to consider is your debt to income ratio. I think this information will help people because when it comes to planning, you need to know this. If you're going conventional loan, you want to make sure your debt to income ratio is less than 43%. What's your debt to income ratio? This is the ratio between your liabilities and the amount of money that you make monthly. Now, back in my underwriting days, I've seen people get approved with debt to income ratios up to 50%, but try to stay in that 43% and below. That way you ensure that your loan is going to be approved. So that pretty much covers some of the main points with conventional loans. If you find that information to be helpful, go ahead and hit the like and hit the subscribe button because we'll be dropping more videos providing you with more information so you're armed with all the tools you need in order to purchase your home.